These picks that we're going to talk about today, if it wasn't for data centers, they certainly wouldn't have the earnings growth that they have.
The demand is virtually insatiable when it comes to artificial intelligence and some of these picks that you're going to be talking about.
Some people collect, Pokemon cards or baseball cards, or in Brad's case, maybe real estate. To me, I like the idea of collecting these things, but ultimately I collect, for the most part, dividends.
They provide these products in the automotive, aerospace, and broadband, industrial, but data centers are certainly fueling the demand.
There's going to be a black swan event that occurs, and when those events happen, that's the time to pounce.
Hi, everyone. It's Brad Thomas, and welcome back to the Wide Moat Show. I'm joined by my co-host, Nick Ward. Nick, it's great to see you today.
Yeah, great to see you, Brad. Happy to be here. Great day in the markets today to start the week. Earnings season is getting started, and I think Wall Street looks excited about these numbers. So I'm looking forward to the next few weeks in the market.
Great. Well, speaking of earnings, a couple of the REITs posted earnings last week. Three of the major industrial REITs actually wrote about them today in the widemoatdaily.com. Please sign up for the Wide Moat Daily, where we get all the daily news. But the REITs have started out pretty strong, Nick, but we're not going to be talking about REITs today.
No, we promised last week we would talk about my holdings. And over the years, I've kind of had to trim down my REITs a little bit due to some of the work that we do in publishing. So I currently only own one, and that's Realty Income. Surprise, surprise. Everybody knows Brad and I love Realty Income. But all my other real estate position comes from my personal residence. So Realty Income and my house here in Central Virginia, that's my real estate exposure. Most of my stocks are in tech. We talked about my holdings, my top 20 holdings, I think about a month ago on this channel. So in this video, I'll give a quick recap there. I'll talk about what it is that I've been buying recently, and then we'll get to like the main subject of today's video, which is, I guess Nick's number one secret to getting wealthy in the stock market.
That's great. Well, interestingly enough, Nick, you mentioned, that I can't wait to talk about some of your picks. And again, a lot of these are technology focused or technology based. But of course, I looked at these companies. I did a little preparation, did a little homework before this particular show. And Nick, I got to ask you, without data centers, and I know we did a show a couple weeks back on technology, and I touched on the data center sector, but Nick, without data centers, I don't think any of your picks would be picks. Is that right?
Yeah, no, I don't think so. All the picks that I'm going to talk today, or at least two of the three big time, make a lot of hardware that goes into data centers. So they've certainly benefited in a big way from this big AI boom in recent years. Yeah, Brad and I think 2 weeks ago on this channel, we did a data center video where Brad, you talked about DLR and Equinix and Iron Mountain. So yeah, if you guys are interested in Brad's opinion on data center REITs, we have recently covered that. I thought that was a great video. Those are pretty interesting companies. I was surprised by some of the fundamentals. Iron Mountain, I had no idea they were growing the way that they're growing now. I was still thinking of them as kind of the old Iron Mountain and hadn't come around to them being the new Iron Mountain. So kudos to them and kudos to you on that. But yeah, you're right. These picks that we're going to talk about today, if it wasn't for data centers, they certainly wouldn't have the earnings growth that they have.
Yeah, Nick, and listen, I think the demand is virtually insatiable when it comes to artificial intelligence and some of these picks that you're going to be talking about shortly. So I'm anxious to get going. And I know last time we did this, Nick, we had a lot of people watching this video. Obviously, people are really interested in what you're buying and what you're selling and what you're holding. So let's get the party started here.
Yeah, here we go. So I guess we'll just start it. Easiest way to do this is I'll put up a graphic here just showing my holdings. I know people love to see that. I never show how many shares I own, exactly how much money I have. That's private information. That doesn't need to be on the internet. But here's my positions, my cost basis, my gain loss, and my portfolio weighting. So as you guys can see, I'm still highly overweight tech. My top 5 largest positions, they make up about 35% of my portfolio. So that's pretty heavy overweight. If we're looking at the top 10 positions here, that's 52%. So there was a time where I think most of my positions were all about, 1% to 2%. The top 10 positions would have probably been about 25%. But over the years, my biggest winners have ran so far, and I just haven't trimmed them. And that's why, we have a top 10 here at 52% of, essentially my net worth. And I feel pretty comfortable with that. Brad and I talk about sleep well at night. We talk about diversification. I know you'll hear a lot of people say, no more than 5% into one company, no more than, Mr. Wonderful's famous, I think, for saying no more than, 5% in any one company and no more than 20% in any one sector. I certainly break those rules. There was a time when I didn't, but the kind of topic of today's video is why my portfolio looks like that. And it is kind of the magic of buying and holding. I think it's pretty easy for people to buy stocks. We all love collecting things. I think that's part of human nature. Some people collect, Pokemon cards or baseball cards, or in Brad's case, maybe real estate. To me, I like the idea of collecting these things, but ultimately I collect, for the most part, dividends. I just love every share pays a new dividend. That's what I like to do. And I hate to sell them. So I've seen quotes, and I don't know who first said it, but they talk about, buying and holding is great, but it's the buying part's not the hard part. It's the holding part that's difficult. And it's the holding part that ultimately leads to success. So now you see my holdings, and you can see I've got some small ones at the bottom. And generally speaking, what happened there is I bought some shares hoping they would go lower. I don't like to average higher into positions. I will 5 to 10 years down the road, but in the short term, I'd much rather buy lower. So if I buy something at 100 and it immediately shoots up to 120, well, I'm probably just going to go look for a deal someplace else. So some of my smaller positions, that's what happened. But then I don't sell them. I don't see the point in really trimming them just for the sake of trimming them. I'll just hold them. Maybe one day they'll grow into a big position. My top positions, my cost basis, in Broadcom, Nvidia, Apple, etc., it's very low. Like the amount of money I have invested into them, when I make a trade now, it's that same amount of money. Just what I bought those things when I was, 22 to 25 years old, and I didn't have very much money back then. So I'm certainly grateful. You can see 1,000% plus growth. They've turned into large pieces of my kind of financial life, but at the time they weren't very large investments. So that's also an example of the benefits of buy and hold investing. Here's a chart for the S&P. This is not one kind of individual company that I own, but as you can see, over the long term, here's 100 years-ish up and to the right, very consistent. And as you can see, there's World War II, there's the Great Depression, the Great Recession, all these major things that have happened in the 20th and 21st centuries, and yet the U.S. stock market just keeps climbing higher. So there's always going to be somebody out there saying, well, this time it's different. We're going to have some 50% crash. It's going to result in, the U.S. turning into Japan, and just, 30 years of flatline growth in the markets, et cetera. But that's never been the case before. Maybe next time it will, but I'm certainly not going to be the person that goes against, 100 plus years of success in the U.S. All the this time it's different folks. I tune them out. Sure, we may get a dip soon. That's bound to happen. We saw a big sell-off back in January with DeepSeek. We saw another one in April with Trump's Liberation Day news. Those are going to happen all the time, but the U.S. stock market has always bounced back, and that has always benefited people that buy and hold stocks. So, Brad, I'll let you chime in here before I transition to the three companies I'm going to talk about today. Any thoughts on that, on buy and hold investing, on the trajectory of the U.S. stock market at a macro level?
Sure. And Nick, thanks for this overview. Look, I think when it comes down to it, it's up to everyone to have their own risk tolerance level. And Nick, congratulations on the picks that you've made and what you've revealed to our followers here at the Wide Moat Show. But definitely risk tolerance is really critical. Diversification is a big part of this risk mitigation process. And the fact that you have so much overweight of your own money into these technology-based companies is really significant. It tells me a lot. And when we go into these individual companies, because I did my own work too, as I said, and I've looked at these companies, that you've purchased. I don't own shares in any of these major three we're going to be talking about. I wish I did. But I think it's really important. The other thing I want to mention, and I think there's a common thread to really all of Nick's picks, and he mentioned this, and this is also applicable to our coverage of REITs, business development companies, master limited partnerships, all of these alternatives, income alternatives. They do one thing: they deliver consistent, income, and they do that because of earnings growth. And what was really compelling, I actually put together 3 charts for you just for this show because I wanted to see our audience to see the earnings growth that has been generated with all 3 of these picks is just amazing. And it's clear that you've done a great job with diversifying and really overweighting sectors that are generating the highest earnings growth, because that's exactly how you have outperformed the market. Because you understand the power of earnings and the power of dividends.
Yeah, no, I'm always looking for secular growth trends. So secular growth is earnings and fundamental growth that should happen regardless of the macro economy or regardless of where interest rates are or what the president's newest policy is, et cetera. All 3 of these picks, or 2 of these picks, are based on the AI move. I made them over the years. And then 1 is based on aerospace and defense growth. So we'll just get into the picks here. So none of these are good values today. I'm sorry. This isn't a video of here's 3 hot stocks to buy. In general, I think the market's pretty overpriced. I haven't been buying a lot recently. I did go look at my trades. In the last few months, I've only bought 3 companies. I bought Waste Management. I think below 220, it's fine. It's not great, but I've been buying it. I got to do something with cash. I don't like to do nothing. I always want to be collecting my dividends. So I've been buying some Waste Management. I bought some MMC, some Marsh & McLennan, insurance brokerage firm. I think right around 200. I think, like I said, they're fine. I don't think it's a great value, but they're a great compounder. I've been happy to add to that position. And I recently bought some Moody's on the drop. Once again, maybe even a little overvalued here. Every month when I collect my dividends, I have to do something with them. And I thought Moody's was an intriguing thing down here below 500. I love the double-digit growth. So, all 3 of those companies, once again, very solid fundamental growth, very solid dividend growth. And the same thing goes with the companies I'm going to talk about today that I'm not buying, but I am holding. Because when we do these portfolio reviews or when I'm talking about trades I'm making in these YouTube videos, people will constantly say, well, Nick, what do you think about selling this thing? When do you plan to sell it? And I think too many people get caught up on that. They see a gain and they want to lock it in. But to me, I think it's Warren Buffett has said, his ideal holding period is forever. And to some that might seem silly, but to me, that's exactly the case, because I'm not planning on, when I buy a stock, my goal is not to sell it in 7 years and then live off those profits. My goal is to hold it and live off the dividends that it pays, hopefully like forever. Sorry, I'm going to butcher that word here. So the number 1 stock I'm going to talk about today is my largest holding. It's something we've talked about a lot on this channel, and that's Broadcom, ticker symbol AVGO. This is a semiconductor company. It's actually made a lot of acquisitions under its CEO, Hawk Tan, and they're about 40% software also at this point in time. So they're becoming a more diversified technology company. When I first bought them, it was all semiconductors. It was mobile phone type chips. It was connectivity chips, networking chips, et cetera. And over the years, they've developed and evolved into a company that is the world's leading name in these custom ASIC AI chips. So that's, I think, seeing Broadcom's evolution over the last 10 years from basically like a mobile phone-ish chip company into an AI company is pretty amazing. If they were still a mobile phone company, the company would trade for 10 times earnings. Nobody would be interested in those kind of boring, low growth, low margin chips. But as any good company should, they've evolved and now they're into the high margin space. They're into the high growth space. So this is an example of me trusting their management team, trusting their execution, and just simply holding shares. I'm up 1,400%. And last time I said this, people said, what's your exit strategy? Well, I don't have one. My exit strategy at the moment is just to hold, as you can see on this fast graph, Broadcom's supposed to grow earnings 38% this year. In my opinion, you've got to be crazy to sell something growing its earnings at 38%. This company has been growing its dividend at double digits very consistently throughout the entire time I've owned it. There was even a triple digit dividend increase back in, I think, like 2014, right after I bought this company. So they've been very generous. 38% fundamental growth to me points to another, maybe 15% dividend increase this year. They're expected to grow at 40% next year. So there's massive fundamental upside here with Broadcom. Yes, it is way more expensive now than it's ever been. This custom AI boom has certainly bolstered the premium on this company, but I think the fundamental growth will support that. If we, as you can see on this fast graph, Broadcom trading for 53 times right now. I would have never bought the stocks at 53 times. This thing, I think I bought it back in 2015. It was trading for like 14 times. So very happy to have bought it then. I'm not buying it now. However, I'm not selling it now because of that fundamental growth. If looking at the chart here, 30 times earnings is probably about fair for a company growing at 20 to 40%. Obviously, it's not going to grow that fast forever, but in the meantime, it is. I think 30 times is probably fair. Well, 30 times 2027 expected earnings is $410. So it still has $50 of upside relative to that, even if we see the multiple compress just because of the fundamental growth. And in the meantime, the dividend will go much higher. So this is an example of, I don't think there's any need to sell something like this. If you're going to retire tomorrow or something, maybe I could see, moving into bonds or REITs or BDCs, something lower risk. But for me, I'm 35 years old. I hope to be alive for another 35 years, at least. So I want to own growth names. This is a great growth name. And unlike a lot of growth stocks, Broadcom does reward investors with a very solid dividend growth. So to me, this is kind of like a have your cake and eat it too type of company. So Brad, I know you don't own Broadcom, and I'm not even sure how closely you cover it, but I know you said you did some homework on the 3 tickers I sent you last night. So interested to hear your take on this company and kind of what you would do with it moving forward.
Sure. Well, obviously, because we cover the real estate infrastructure space and data centers and telecom, fiber, and all of that, I think it's really critical to understand, Broadcom and the other players in this sector. Of course, we wrote about the deal with OpenAI just recently, which was a massive deal, like 10 gigawatts of AI accelerators, which is enough power to run just a small city. And that's just one of many, many deals that Broadcom has put together here. I put together this chart. I mentioned this to you earlier. Since 2010, this is earnings per share of the company. And what's really impressive, and Nick, again, congratulations, because you caught this one really, really in the early innings. Broadcom has generated earnings growth of 27% annualized since really the last 15 years, from 2010 to 2025. Again, that's 27% CAGR. Now, in 2026, consensus analysts is 40%. In 2027, analyst consensus is 28%. So still continued powerful earnings growth, which, to your point, Nick, is going to generate more dividend growth, consistent dividend growth, and of course, higher returns. So I can definitely see why you're not selling this company. It's definitely a buy and hold for a long, long time. Again, this demand in AI is insatiable, as evidenced by this chart here with Broadcom.
Yeah, I was looking at, it's funny, by 2025, my cost basis, what's my cost basis here? My cost basis is $23 a share. I think it's realistic that by 2035, this company could be earning $23 a share. So, I mean, we're talking a 1.0 P/E ratio based upon my cost basis. So at that point, it's just, sure, maybe you could sell your original cost basis, take the money out, let the rest run, et cetera, if you really wanted to, but it's all gravy. I can't think of a scenario at this point in time where I ever really kind of lose money with Broadcom or even come close. So to me, I just sit back and watch this one. So with that being said, we'll move on to another one. This is a very long-term pick. And now I want to talk about a short-term pick that I made earlier in this year that I do think is overvalued. And another reason why I don't sell things is because of taxes. So we'll talk about Amphenol. That is a very boring company. Here's this is from their website. This is their products. This is what they make. It's connectors, cables, sensors, antennas, the circuit boards of computer chips. all hardware things. They make a bunch of wires, basically. They make all the wires that connect the world. So that was kind of my second level thinking back in January when DeepSeek happened and everybody thought all this data center build was just going to go out the window. One, I didn't believe it, but two, I was trying to pick up some companies that I wish I had bought 5 years ago that I missed. And this was one of them. This is a very boring industrial for years and years and years. And now it has become a very exciting AI stock, over the past few years. So the premium has gone way up. Ticker symbol APH. As you can see here, they're trading, I'll put up the fast graph. They're trading for, well over 30 times right now, I believe. Sorry, my computer's going slow. What do we got here? Yeah, they're trading for 45 times earnings. This is, once again, the most expensive that shares have ever been. But that wasn't the case earlier in the year. Earlier in the year, I was able to buy these shares for 25 times earnings. So I liked it at 25. I don't like it here at 45. If I could sell this company, scot-free, I'd consider it. But the problem is I can't. Short-term capital gains rates is 22 to like 35%, I think, for most people, depending on, it's based upon your income. I think that's from 48,000 to 500,000. So I think most people probably watching this show fall in between those parameters. So I did a little bit of math here. Let's say I'm up about 100% since I bought these shares in January. So let's just say you bought $1,000. It turns into a $2,000 investment. You got to pay $240 in taxes if I sell it right now, based upon that, that $1,000 gain. For me, if I take that, my profits post-tax from this company and try to buy something else, whatever I buy has to go up 12% before I even break even on a relative basis. And it's hard enough to pick winners in the market. I don't want to set myself back. So yes, I could lock in 100% gains now. That feels great. Pat on the back. I made a lot more money in, 7 months with this company than I expected to when I bought it. However, if I go look for another, adjacent company, another data center play, maybe one of Brad's data center REITs, before, like I said, because of the taxes, that company has to outperform APH by 12% before, just to break even. And then from there, it's a race. So that's a disadvantaged situation. I hate paying taxes. I pay them on my dividends. That's just the price of doing business. There's really no way around that besides retirement accounts. But that is a major thing that I think a lot of people don't think about, the transitional kind of transactional friction of trading on a regular basis. A lot of times when people talk about my portfolio, they say, why don't you trade? Why don't you sell out? Well, that's a major reason why I hate paying taxes. And I feel like you're setting yourself kind of, behind the field, from a racing analogy point of view, when you have to pay those taxes on your gains and then make them up later. So I just don't do it. I just hold the companies. APH, here's the fast graph. As you can see, the premium is very high. It grew its earnings at 60% this year. That's what it's expected to. And then 15% moving forward. So eventually 15% growth will justify the current premium. Sure, this company could underperform the market or its peers in the short term because of the very high premium associated with shares. But the fact of the matter is, I think what JP Morgan said, there's going to be like $3 trillion worth of data center spend over the next decade, I think the other day. A lot of that money is going to this company. What are data centers? They're made of semiconductors and wires, basically, a lot of connectivity hardware. So this is a company's going to benefit, and it pays a great dividend. It's the yield's only 0.5% right now. It was over 1% when I bought it. I have some data here. What do we got? We got a 12-year dividend increase streak, very consistent growth. Here's the chart from the company's website showing their dividend trajectory. And the only reason that last bar is low is because they haven't paid the Q4 dividend. So once they pay the Q4 dividend for 2025, that last bar on the chart will be another stair-step pattern in the right direction. And I don't see that ending anytime soon. The payout ratio here is really low. They pay a 70 cent per share dividend. They're earning over $3 per share. So even if they don't grow earnings, Amphenol can continue to increase its dividend. But since they are growing earnings at that, kind of mid-teens rate, I think 10+% dividend growth here is very likely moving forward. So Brad, I'm interested to hear your take on Amphenol.
Yeah, so I said this a couple times already. Data center and AI spending is virtually, unstoppable. Now, at some point, it's going to cool off, but not just the REITs that we cover, the public companies, but the private companies that are making massive, massive investments in these data centers. So once again, I put together this chart to demonstrate, Nick, how good you are in your picks. And again, A+ with this one. You can see here earnings per share since 2010 to 2025, last 15 years. Nick, I know you got in earlier, which is actually a really good idea. But over the last 15 years, you've seen 17% annual returns. That's 17% CAGR since 2010 to 2025. Now, what's really interesting, you can see that big spike up from 2024 to 2025. That's about 60% growth. And again, this is analyst consensus. We haven't finished the year, but look at that growth. So it's a great time to get in early, Nick, like you said, and capitalize on this. And most of that, a majority of that, is obviously in the data center space. Now, obviously, they've got other sectors they provide these products in the automotive, aerospace, and broadband, industrial. But data centers is certainly fueling the demand. And then you can see here on this this chart I put together again, in 2026 and 2027, analyst consensus indicate we're back to kind of this normal growth range of about 15, 16, 17%. So certainly this is Nick, and you make a great point with the taxes. And I think that's really important point to make to our audience is what are you going to do with this money? If you sell it, and you got to look at the after-tax, attributes. So I think this is a wise pick. Definitely, Nick. And again, there's an old saying, I'm sure you've heard this before. If it ain't broke, don't go try to fix it. And
I agree. Yeah. The problem with these types of companies is people are going to look at that chart and say, well, Nick, thanks for nothing, because sure, it's a great company, but when am I going to buy it? And the fact is, I thought the same thing for probably 5 to 10 years on this company. And then DeepSeek happened and I pounced. In January of this year, I bought a bunch of shares. In February and March, I'm looking at it. January 27th, February 18th, March 3rd, March 13th. That's when I built this position from $66. I averaged down to $61. So sentiment will turn on every company at some point in time. You might have to wait 5 years, but I think you just have to have a list of companies kind of in the back of your head, maybe on your mirror. So you look at it every morning when you brush your teeth. If this company's ever down 20%, I'm going to buy it. Just period. Because those are always overreactions. I've been waiting for this company. I think our colleague, Leo Nielsen, who was on this show a couple months ago, he kind of brought this company to my attention. And for years, he had been writing these articles like, man, this is one I want to buy, but it's too expensive. It's too expensive. Well, earlier this year, it was no longer too expensive. I was finally happy to buy it. And knowing that I may not have a chance to buy more shares for another 5 to 10 years, I'm certainly not selling the ones I own. These things are precious. APH shares bought at a fair valuation is a very rare thing. We're talking about collecting things. It doesn't get much more rare than that. And I'm not going to sell, my rare precious possessions because I would likely downgrade. People talk about, I'd sell one card, trade it to you for another card. If I trade these shares for basically any other shares in the market, I think it would be a downgrade. It would be a loss for me. So I'm just going to hold them and happily do so. And with that being said, the last company, this is another name that I've made way more money with in the last few years than I ever expected to when I bought the shares. When I buy shares of a high quality dividend growth company, I'm generally expecting between 10 and 20% annualized gains. You get 2% from the dividend, 8 to 12% earnings growth. And then I usually buy things when they're undervalued. So I get a little multiple expansion. Every now and then you're surprised. The market does something you would never expect. And that's what's happened with Parker-Hannifin. I was buying this company back in 2023. It dipped down from about 20 times to 15 times. Thought it was a pretty great opportunity. Well, it's up 190% since then. I would have guessed by now it'd be up 50%. So it's done way better than I ever thought it would. Here's the fast graph. Once again, the premium today is way higher than it usually is historically. You can see down in 2023, there's the dip I bought. Now it's up at 26 times earnings. So it's not as expensive as some of the other ones, but its long-term average is 16 times. So that is a pretty massive premium relative to the average. The growth here is not quite as exciting. It's high single digits. historically very consistent. But last year 18%, this year 7%, and then 7 to 9% moving forward. So this, I think, is a more boring company. This is maybe more in dividend investors' wheelhouses. This is an industrial conglomerate. Here's their kind of website, what they do: aerospace, digital, electronics, health sciences, construction, manufacturing, etc. You can look at this this website here from their investor relations page. They do a little bit of everything. But what I liked about this company when I bought it is they had this plan to change from sort of short-term, more volatile cycles in the industrial space to secular growth trends. We started this video with secular growth. I'll end it with secular growth. Here's kind of the chart that this company has made. They put this in their investor decks to kind of prove to people why you should buy them. In 2015, as you could see, longer cycle growth, which is how they describe secular growth trends, only made up about 20% of this company's revenue. Well, by 2029, it's expected to make up more than 50%. And in fiscal year 2025, it's already at like 33%. So they're selling off, they're divesting, more volatile, short-term, cyclical assets and business revenue streams, and they're investing in more heavily and then using M&A to buy more secular streams. And that's mainly aerospace. I love that trend. You've got globalization, you've got urbanization, you've got all these mega cities popping up throughout the world. How do people travel between them? Well, they do it with aerospace. And then you're also seeing that in the defense sector. People are investing very heavily into drone technology, into missiles, et cetera. Well, this company makes bits and pieces of all of those hardware, components of those industries. So Parker-Hannifin, I never expected it would be up this much. But I did the whole tax thing again. Maybe this will be boring, but this is important to me. Say you put $1,000 into this when I did back in 2023. It's up 200%. So you've got $3,000 now, $2,000 profit. That means you're paying, at a 15% tax rate. That's usually what the long-term gains is for most people. You're paying about $300 in taxes. Once again, if I said last week I like Honeywell. I do like Honeywell a lot. I think it's kind of a close comparison to this company. Much cheaper, 20 times versus 26 times. The problem is Honeywell would have to outperform Parker-Hannifin by 10% for me to break even because of my taxes, because of that $300 I would pay in taxes on this $1,000 investment. So I don't know that it'll do that. I would rather just buy Honeywell with new money and hold Parker-Hannifin than kind of make this bet that Honeywell is going to outperform Parker-Hannifin by at least 10%, over the next year or two. To me, that's very speculative. Parker-Hannifin's growing its earnings, high single digits. It's growing its dividend at a double-digit rate in most of the recent years. It's got still a very low payout ratio, $7 a share in dividends this year, roughly $29 in EPS. So once again, even without growth, this company could expand the dividend pretty aggressively and still have a safe payout ratio. With the growth, I think double-digit annual growth is very likely. That means the dividend's doubling every 7 years or so. So sure, the yield's low right now, but in 15 and 21 years, it won't be. It'll be a pretty significant piece of my income pie. So the tax component plays a role here from the long-term perspective as well as the short-term perspective. It's like I said, it's hard enough to pick winners. It's hard enough to find these companies trading at fair valuations. I don't want to set myself behind 10 to 12 to 15% with these taxes. So Brad, what were your thoughts on Parker-Hannifin?
Yeah, this is a really interesting pick, Nick, and I think it's a good one too. Looking at the company again, I'll show up the chart here right now. Since 2010 to 2025, over the last 15 years, this company has generated about 17% growth on a CAGR basis. Now, you can see it's a lot lumpier growth, especially going back to 2010. Earnings haven't been as predictable. However, what's happened, this company has really started to utilize its scale advantage. It's grown its sales from $12 billion about a decade ago to $20 billion in sales. And you can see the more recent sales history. All you've seen is up and up and up. There's not a whole lot of lumpiness to this business model. So they've obviously been allocating their capital wisely, making accretive investments, growing this business much like a REIT does, to your point earlier, Nick, diversifying this business into many different sectors of aerospace, defense, industrial, transportation, energy, HVAC. So that scale advantage is obviously going to help increase diversification, while also, most importantly, generating positive earnings over growth. Now, in 2026, analysts are forecasting about 7% growth. In 2029, 9% growth. So not 17% growth, but still continued growth going forward. So definitely like this company. I like the fact that it's growing its sales, but more importantly, it's growing its earnings and its dividends. So Nick, I think this is a great pick as well.
Yeah. All right. So I think that's basically today's video. Hopefully this wasn't too boring for you guys. You see my portfolio, you see all those green numbers. Well, the fact of the matter is the strategy that led to that is a pretty boring strategy. I find companies like these three that compound their fundamentals at a very consistent rate. I buy them when I think they're fairly valued, and then I do my best to avoid all the temptations. I get temptations too. I'm scared of all these different things that could happen in the market that lead me to maybe should you sell your stocks, maybe should you go all cash, maybe buy gold, etc., whatever. Just ignore all that noise and just hold on to my stocks. Allow the compounding process to play out. So it's not exciting. It takes a lot of patience. It takes a lot of discipline. But hopefully these numbers kind of show you that it works. I don't think I'm a genius. I'm able to identify high quality companies, and I'm able to hold them for very long periods of time. And that could work. It works for me. It could work for anybody. So I hope these types of videos kind of prove that point. I hope I kind of hammered home, hey, you don't pay taxes, you don't need to pay, etc. And then I hope I gave you some ideas. There will be a sell-off moving forward. There'll be another DeepSeek. There'll be another Liberation Day. We don't know what it is. There's going to be a black swan event that occurs. And when those events happen, that's the time to pounce. So hopefully that helps you guys. Next week, I think we're doing Brad's famous Trick or Treat REIT recording. So Brad's been doing those for years and years and years at Seeking Alpha. We're happy to do them on YouTube now moving forward. So I look forward to that next Thursday. This week was a lot of me talking. Next week, it's going to be a lot of Brad talking. So with that said, I'm going to sign off and let Brad say the final goodbye here.
Great. Thank you, Nick. And thank everyone for watching. Nick, this was a really good episode. I know folks really enjoy hearing about your picks. And yeah, next week we're going to trick or treat my favorite REITs. And I don't know, maybe I'll break out a costume, Nick. If we both break out a costume, I think we'll get more followers next week. So we'll think about that.
I'll do my best.
All right. Thank you all for watching, and happy sleep well at night, Swan Investing. We'll see you next week. Hi, everyone. Thank you for watching today's episode of the Wide Moat Show. Please comment, like, and subscribe below, or go visit us at widemoatdaily.com. As always, happy swan, sleep well at night investing.